Throughout this video, we're going to be talking about the different cost concepts using the example of Harsh Electrical's case study that you can find linked to this video.
Listed here are the different cost concepts that we're going to be focusing on throughout this video. So the first is cost systems. Primarily, we're going to focus on job costing for this case study. And then we're going to move into the unit product cost and how we calculate that. And then the different components related. And then we're going to look at a cost of goods manufactured and cost of goods sold statement. We'll then finish out with looking at a projected statement of income and then also looking at the profitability that each product will have for the company. And then we'll look at break even and target profit for the different products in the company as a whole. Two cost systems listed here are job costing and process costing. Process costing is when you have a single product producing on a continuous basis over a period of time. Job costing is when you have multiple products within one job that you are working to complete rather than just individual products. So for this project, we are looking at job costing. Just to reiterate what job costing is, you see in this picture that you have multiple things going on within each product. You have the materials that go in, you have the direct labor that goes in, you have overhead that goes in, and it's all recorded on a job costing sheet for that particular job, whether there's 1, 2, however many products that there are.
As you can see from this picture, variable costs and fixed costs depend on whether you're looking at the product or not. So variable costs are based on the level of activity for each of the products, while fixed costs do not change based on the level of activity. Some examples of variable costs may be raw materials, labor, and other manufacturing expenses, which we'll take a look at when we look at the Harsh Electrical's example. Some fixed costs may be salary, rent, depreciation, but again, you also may have to look at variable and fixed expenses based on manufacturing overhead. Another cost piece is manufacturing overhead, which is an indirect cost incurred during production. Manufacturing overhead is an overarching cost that relates to the product in some way. It can either have a fixed or variable piece. So examples of this would be rent, wages, depreciation, or anything that is related to the product and used in the operations. In the Harsh Electrical example, we will see different manufacturing overhead that would be included and what's not. Another thing that needs to be considered is product versus period costs. So product costs are your variable costs, like your direct materials, direct expenses, direct labor, manufacturing overhead, and those all are related to making the product. Period costs are your admin expenses, your selling expenses. Your period costs are what is going to be viewed in your income statement, which we'll see later in this video. Okay, so we're going to calculate the cost per unit for both the standard and Bellino model. So this was originally given in the case that we have. So we know the total direct materials that was given. And then they told us that the drilling bit per unit was 10 and 10 for both models. And then the power we know was 1 and 1.5 for standard and Bellino respectively. And then we know that it's $10 for the power. So that's where we get the 10 and then the 15. So all of this up here, which I will then get to the labor costs and the manufacturing overhead, but all of this is variable costs. So variable costs, it all depends on what is being put into the product and all the materials that go into making the product that will affect what goes in and what does not. So here's our labor costs. So we know that each laborer that's working on it was paid $200 per day for 8 hours each day. So we divide that out and get $25, which is the rate per hour. And then we have, for the time completed per hour, we know that it was 60 minutes and 72 minutes, so divide to get it to hours, you have 1 and 1.2 for both the standard and Bellino models. And then multiply it by the rate, and we know that per unit it's 25 and 30 for each of the models. And then we have a total production for the whole year, and then what you are actually selling. So over here, I have a little chart that is units that we're actually going to sell, and we know that we're going to be selling 4,000 units, but we know that we made an extra 70 units for the off-season production. So this is how much we actually produced for the entire year. So we multiply by what we actually produced for the year to get the total direct labor costs. And the total direct labor costs here is what's going to be our cost driver for when we do the manufacturing overhead. So we just take the 20 and the 25 for the labor costs per unit for both the standard and Bellino models. So then looking at manufacturing overhead, the manufacturing overhead piece has both variable and fixed costs in it. So that's why we see we have Nagesh's salary of $600,000. And then we have indirect labor, which this person is a setup manager who is getting paid $6,000 for the 6-month production period. So even though we're doing it over a whole year span, he is only getting paid for the 6-month production period, and that's where we get the $36,000. And then we have rent for the workshop, which we know from the case, we broke it up because we have a workshop rent and then an office rent. So the total square footage rent piece is 1,200 square feet, but 150 square feet of that is allocated for the office. So we're only going to be using 1,050, and then we're going to multiply it by the $8 that was given to us of how much it is per square footage, and then multiply by 12 for the entire year, because even though we aren't producing for 6 months, we still are paying rent for those additional off-season 6 months. So then we have depreciation of the workplace as well. So there was a chart given, it's Exhibit 2 of the case, and it's plant and machinery and then workshop furniture and fixtures. And we're looking at depreciation based off of a straight line basis. So for the plant and machinery, we take the $320,000 minus the salvage value and then divide by the life, and we get $60,000. And then same thing with the workshop furniture and fixtures, $40,000 divided by 10 to get $4,000 depreciation. Add that together and you get the $64,000. For electricity, over here in this chart, we broke it up based off of what we see in Exhibit 4. And so, again, we have a workshop electricity piece and then an office electricity piece, but we're only going to include the workshop because that is what is pertaining to the standard and Bellino model, not the office. So we see that we broke it up into peak season and off season. And here we see that we took the total units produced multiplied by the standard unit production, and then $10 for the cost per hour. Same thing with the Bellino model. And then maintenance, we did $10 times 6 months times 10 for the maintenance. And then factory lighting was given to us, again, $300 and multiplied by 10 multiplied by 6. So all of this was all stated in the chart that was given, so we just multiplied it based upon if it was peak or off season. So we get a total workshop electricity amount of $69,950, which we put over here in our manufacturing overhead. So then we also have a workshop insurance and then additional production consumables, which was given to us, so we include that because, again, that is also pertaining to our production. So just because it's not specifically working on creating the unit, we have this workshop insurance that's going to be included because it's part of the production process. So then we have the procurement cost, which we found is a 0.5% of our direct materials. So we took the direct materials of the standard, multiplied by how much we're actually going to produce, and then multiplied by that 0.005 for the percentage. And we did the same thing for the Bellino to get the total procurement cost of $37,830. So then when we add all of our manufacturing costs up, we get about $978,580. And then again, we know that our cost driver is going to be our direct labor. So we divide that and get a predetermined overhead rate of 9.25. And again, like we said, to get the cost per unit, we are going to multiply it by our cost driver, which is the direct labor per unit, so 25 and 30. And this is going to be how much our overhead is going to be per unit. So we come back up here, and we see that we put it in as our applied manufacturing overhead amount. And this is how, when we add everything up together, that's going to be our total cost per unit for both the standard and Bellino models. Here's a basic example of what a cost of goods manufactured and a cost of goods sold statement looks like. So you can see by the arrow that they feed into one another. So once you figured out your cost of goods manufactured, you use that number and put it into your cost of goods sold. So for your cost of goods manufactured, you have to take all of the materials, labor, overhead, everything that applies to the product to get your total manufacturing cost. Once you have your total manufacturing cost, then you add in your beginning work in process inventory and then deduct any ending work in process inventory that you may have left over to get your cost of goods manufactured. You then plug that into your cost of goods sold statement, which you have just your finished goods, your beginning finished goods, and then take out your ending finished goods, and then you may have to add or subtract any over or undersupplied overhead to get your cost of goods sold. We will now look at Harsh Electricals as an example and see how their cost of goods manufactured and cost of goods sold statement looks like.
So now we're going to take a look at the cost of goods sold and cost of goods manufactured. In order to calculate cost of goods sold, you must first calculate cost of goods manufactured. To do this, you have to add direct materials, direct labor, and manufacturing overhead. So in this case, there is no actual beginning raw materials inventory. So what we had to do was add what we purchased during the period. What we purchased during this period was $5,796,280 for the standard model and $1,769,850 for the Bellino model. And then over on the right, you see that we have a total column. This is going to be the totals of both the standard and Bellino model combined. So then we got our total raw materials that we have available. Now we have to deduct any ending raw materials inventory. Since we didn't have any here, this is an easy step for us. So we now have our raw materials used in production. Then we move on to direct labor. Direct labor is, you can see as we calculated in the cost information, and was a total of $105,800. So after we deduct these and other direct costs, we now have to look at manufacturing overhead. Manufacturing overhead for this period was $978,580.65. You can see our calculations for this over in the cost information tab. And then for cost of goods manufactured, you look at beginning and ending WIP. WIP stands for work in progress. Since we didn't have any here, we can skip this step and we have a total cost of goods manufactured of $8,735,960.65. So now we move down to the cost of goods sold statement. As previously stated, you need to use cost of goods manufactured and cost of goods sold. So we start with our beginning inventory, which we had none, and then you add the cost of goods manufactured. So that's that $8,700,000 number. You then must deduct any of the finished goods that you didn't sell during the period. During the period, we had 60 units of the standard model that we hadn't sold, and 10 units of the Baleno model. We times these by the selling price in order to get our deduction amount. This ended up being $180,000. So after we deduct that from our cost of goods available for sale, we can get our total cost of goods sold, which ends up being $8,555,960.65.
A projected income statement is an estimate of the financial results that you can see in your business in a future period of time. It's often looking at the revenue, your cost of goods sold, your operating expenses, and that's kind of where your product versus period cost will come into play, and you're just looking at how it will look in the future, where your business will be eventually in the future.
So now we'll take a look at a projected income statement for Harsh Electricals for the year ending March 31st, 2014. So a lot of this information is pulled directly from the cost information on our first tab. So if you'd like to look back after we're done explaining these numbers, you can see exactly where we got them from. So our first is our sales. Our sales were $10,400,000. And then you have to take out cost of goods sold to get gross profit. Our cost of goods sold, which we calculated on our cost of goods sold statement, explained in the last screen, was $8,555,960.65. Once you take this out of the $10,400,000, you're left over with a gross profit of $1,844,039.35. Then you have to take out any general and administrative expenses. First, we look at office rent. Office rent was calculated by multiplying the 150 square foot office space times $8 times the 12 months. So this ends up with a total cost per year of $14,400. Then, as shown on the first screen in our cost information, we take out the office electricity, which has a total number of $12,600. And then we also have to take out any distribution costs that we have. Our distribution costs for the period were $400,000. Once you take all these out from our gross profit, you get the earnings before interest, depreciation, and amortization. This number is $1,417,039.35. Then we had to look at our depreciation and amortization. Our depreciation during the period, we had to depreciate our office furnitures and fixtures of $60,000. And this was over 10 years, which would make it $6,000. We also had to depreciate our computer and software. This had a total of $80,000 and only had a useful life of 5 years. So we had to depreciate $16,000. When you add these two together, you can see that we now have to deduct $22,000. This gives us our earnings before interest and tax, which then we have to add our interest and then deduct any tax that we may have. So in our case, it said that we were planning on earning a minimum of $8,000 interest. So we added this to our earnings before interest and tax and get our profit before tax of $1,403,039.35. Once we multiply this by their 12% tax rate, we get an income tax amount of $168,364.72. Once we deduct this from our profit before tax, we finally get our net income of $1,234,674.63.
There are many times in a company when you want to know how many units or how many dollars it'll take to break even, or also if you're looking for a target profit or target number of units that you had based on prior years. So here are the equations that you're going to use to try to figure that out. And again, we'll show you an example based off of Harsh Electricals.
The last part we're looking at is the break-even analysis and target profit. To calculate these, you first must calculate the contribution margin. Our calculation for contribution margin can be seen in the top box. So we're going to be focusing on the per unit contribution margin. For the standard model, each one sells for $2,500, and for the Baleno model, it sells for $3,000. The standard model has variable costs of $2,054.23. To find contribution margin, you have to take variable costs out from our sales price. This gives us a contribution of $445.77 for the standard model and $482.52 for the Baleno model. So now we'll look at our sales mix and break-even point. So for our sales mix was a 4-to-1 ratio. So that means for each Baleno model sold, it'll also be sold with 4 other standard models. Then we multiply this by our contribution per unit, which we had calculated above, and we get a weighted contribution margin total of $2,265.59. Then you can see that we have total fixed costs of $989,750. If you divide this $989,000 by our weighted contribution margin, you then get our break-even point in bundles, which is 436.86. So now you can see that we move down here to our break-even numbers. We start with our total fixed costs and our break-even amount in bundles. Then what we did was we multiplied these out by our sales mix ratio, which was the 4 and 1. So you can see that we now have 1,747 units of the standard model that need to be sold in order to break even, and 437 of the Baleno model, for a total of 2,184. We then multiply them by the sales price per unit, and we get totals for each of the models. Added together, this is our total dollars that we need to break even, the $5,679,216.98. Now we're going to move on to target profit. This is a very similar process, and the target profit just needs to be added to it. So we start with our target profit of $859,846. We add this to our total fixed costs, and we get our total cost, which is $1,849,596. We then divide by our weighted contribution margin, which we had calculated above, and we get our break-even for bundles for our target profit. This number is 816.39. We then, once again, multiply it by our sales mix ratio, and we get our break-even in sales mix units. This is 3,266 for the standard model and 816 for the Baleno model. Once again, we multiply these by our selling price, and we get our dollars to reach our target profit. In order to reach our target profit, we must sell $10,613,040.67.
So just as a little recap of this video and what we talked about the 2 different cost systems of conventional cost systems, but we were primarily focusing on the job costing system. Then we looked at unit product costs with variable and fixed expenses, and then cost of goods sold statement along with the cost of goods manufactured, and then looked at a projected statement of income, break even, and then target profit through Harsh Electricals. Thank you so much for watching our video. We hope you learned a lot about the different cost concepts that you will be able to apply in future business operations.